watching, you say, when's lunchtime, and you get a sleepy speaker. You kind of have to that way. So, but I won't spend a lot of time with you. I just live in Medicine Hat, so if you ever have any questions, you can always feel free to give me a call. A little bit about myself. My name is Darren Hirsch. I'm a commercial account manager at TD Commercial Bank. Been in Medicine Hat forever. Proud to service community in the capacity of alderman for the city of Medicine Hat a few years ago. Incoming chair of the Medicine Hat Chamber of Commerce. And I'm also a business owner myself. I own a franchise called the Pita in Medicine Hat. So I've been across the table as a customer and as a banker. So I kind of feel some of the questions that a lot of people have. I've actually went through that sort of stuff. Like I said, I won't spend a lot of time with you. Again, this gentleman I'm going to introduce, David Tulk, is from Toronto, so I'd rather have him on the stage, and you can always talk to me after. But the organizing committee just asked me, as far as a banker, what are some of the three things, some gems that I can kind of extend out to you as far as some of the things I see on a day-to-day basis with clients who come and see me. So I'm trying to do some myth busting, if you will. First one, banks want so much information it feels like they want to know when you go to the bathroom. Well, a lot of that, if you will, is driven by government regulation. Everyone's aware of the terrorism cells that exist. Banks are actually some of the watchdogs for that. So when we ask questions, are these funds going to a third party? Are you the representative? Is there anyone else being involved in this transaction? Those are actually government-led questions that protect you and protect the bank and ultimately send a little bit of a message to government as far as any activity. So we have to ask questions relative to the fight for anti-money laundering, to flag potential funding of terrorist groups. Also, we are a highly regulated industry, demonstrated with the September 26th Globe and Mail, which was quite timely, that talked about the OSFI, which is the Office of the Superintendent of Financial Institutions, and I just printed it off a little bit, that basically stated, with the pressure on banks to drive revenues, don't start lending money and don't take extra risks. So, there's a reason why Canadian banks are world-renowned for their solid structure and that sort of thing. So, we are tightly regulated. We don't do any maverick lending. TD's example is fairly strong. Those are a couple of just the tidbits. I can get on and talk about personal guarantees and that sort of stuff, but Luke's kind of telling me let's go. We're a little bit behind, so again, if you have any questions, please don't stop by my office. Moving on. Okay, Luke, go on.
I need 2 minutes.
So I'll just introduce my good colleague from Toronto. David Tulk is the Chief Canada Macro Strategist for TD Securities with the Rates and Foreign Exchange Research Group based in Toronto. With a focus on Canada, he provides research and analysis of the global economy and financial markets for the trading floor and a wide range of institutional and commercial clients. David's a frequent commentator in the media and makes a variety of presentations for groups within and outside of the TD Bank Financial Group. Prior to joining TD Securities in June 2010, he worked in the Investment Strategy and Economics Division of the Ontario Teachers Pension Plan. In that role, he was responsible for providing macroeconomic and financial market research and analysis to various groups, including senior management and the board of directors. David was previously a senior economist at TD Economics and started his career as an economist focused on the U.S. economy in the International Department of the Bank of Canada. David holds a master's degree in economics from Queen's University and a Bachelor of Science with honors in economics and quantitative methods from the University of Toronto. David is also a CFA charter holder. Please assist me in welcoming David to Medicine Hat. We don't usually just get this type of caliber, so we're very happy to have him. And David, the floor is yours.
It's always very dangerous to start a presentation, especially on the topic of economics, right before lunch. I'll try my best to walk you through what is an interesting time, to say the least, for the global economy. And it's a pleasure to be out here in Medicine Hat. It's nice to be somewhat closer to a hockey team that does better than what Toronto has been able to do over the last 40, 50, 60 years. So we think about the way the world economy has unfolded, and thinking back over the last couple of months, it's been certainly eventful by any metric, really. If you think about how the world's unfolded from a political process, you can think back to the spring and all the geopolitical uncertainty that we saw with across the Middle East and North Africa and what that did to commodity prices at that time. You can think as well about events in Europe and the second bailout for Greece, and all of the consternation and justifiable concern that the rest of Europe had trying to support this one economy and what it meant for their wider existence, as well as what it meant for their banking system, as well as their economy as a whole. And then you hop across the Atlantic and look at the US, and you can think of the debate around the debt ceiling issue and how that resolved itself in the downgrade of the US long-term debt, something that is completely lacking in historical precedent. So it's been a very eventful couple of months. It's kept me basically wedded to my BlackBerry. Every time I try and go away for a weekend or something happens. I went away on vacation the weekend the US was downgraded, so that cut that vacation short. So I'm happy to come out here, and hopefully the rest of the world's functioning fine. When you think about what's happened over the last year and then think back to where we were in 2010, I think there are a certain amount of similarities and some very clear parallels. This time last year we saw a similar rise of issues in respect to Europe, and we saw a similar slowing in economic activity. And you think about how markets responded to those events. This time last year we saw government bond yields in the US fall quite sharply. We saw the price of gold increase quite dramatically. We've seen the same type of activity in the current year as well. Gold's off a little bit, but I think still holds that status as a safe haven currency. You think about economics as well. If you look at, for example, Purchasing Managers Index in the US, that's a fairly good proxy for overall GDP growth. It's shown a similar trajectory in 2010 and 2011. You look at the new orders component, for example, that gives you a fairly good indication of how activity is unfolding down the road. And if you look at the orders indication in the US economy, it actually suggests that there's a legitimate risk of another US recession. This is a very daunting economic environment globally. But if you think back to what we saw this time last year, we saw on the part of policymakers a pretty sizable attempt to support the wider economy. We saw from the Federal Reserve a purchase of assets. They were basically buying US Treasuries to help economic activity proceed. We saw a sizable program of fiscal stimulus as well, trying to underpin activity. And you can see as the charts that popped up on the far right, how that was actually successful in 2010. Look at the green line, which on the top left shows, or the top right, shows the S&P 500 bounce back fairly sharply. You saw a similar rebound in the price of oil this time last year. And you see where we stand today is a couple of very large question marks. I think these question marks deserve to be there because when we look at where we stand today, we have to ask ourselves, are policymakers in the US willing and able to do the right thing this time around? And to answer that question, we can flip to the next slide, and we can start with the Federal Reserve in the United States. The Federal Reserve has been trying to basically lower yields, lower interest rates in the US, trying to create the right incentive for firms and households to go out there and borrow. And we think about the efforts, and the Federal Reserve has been successful. If you look at the long-term yield curve, it's shifted lower. Yields are much lower. It's much easier now if you're a corporation or a household to try and get financing. The problem is that monetary policy and what you do with the yield curve only creates the right incentive to go up there and borrow. The Federal Reserve can't hold a gun to somebody's head and say, thou shalt borrow. They can't hold a gun to a bank's head and say, thou shalt lend. So without that incentive, we need to be a little bit circumspect about the ability of monetary policy to work. If you look at the current yield curve right now, you can lend your money to the U.S. government at a 30-year maturity, and you're only getting just over 2% back. Interest rates are a great time now to go out there and borrow, but Why is this not really working? Why have we not seen the economic recovery take place? And I think it comes down to a lack of confidence right now. I think if you look at firms and you look at businesses, you look at consumers, you look around the world and they say, even though interest rates are at rock bottom levels, I'm not feeling that comfortable going out there and lending or borrowing. You can think about that from a U.S. household's perspective. You've learned the perils of leverage. You existed through 2008. You don't want any more debt. If anything, you're trying to reduce the amount of debt that you have. Corporations are going through a similar thought process. We don't really know how the world's unfolding right now. We would rather sit on cash, and a lot of corporations in the U.S. are sitting on a tremendous amount of cash. They're not really looking to take on more debt. So what this means from a policy perspective is that this channel is still broken. And we can see that on the next slide, which basically shows you how quickly money is moving around the U.S. economy. The Federal Reserve has been pushing money onto the bank balance sheets, but banks aren't lending it out. It's just sitting on their balance sheets. So we can see that the velocity of money, which just measures how quickly it's circulating through the economy, has fallen dramatically. So the Federal Reserve has just been unable to really support growth from this particular standpoint. So then we look at who else can support growth. And we look at fiscal policy. We look at the U.S. government right now. And there, if you take the tone of the climate within D.C., it's pretty acrimonious. It's pretty unpleasant. You can see the 11th hour showdown related to the debt ceiling. That's an example of a fair degree of dysfunction. The most recent program of job support announced by the Obama administration is unlikely to make itself into law because it has to go through a fairly aggressive Congress right now. So if you're a business and you're a household in the U.S., you're looking at this backdrop and saying, well, I'm not really sure how the regulatory landscape is going to unfold. I know I'm probably going to have to pay higher taxes at some point. So I'm going to keep a very small little economic footprint. I'm going to do my best to only spend what I need to. I'm only going to do my best to invest in just what I need. I'm not going to be very hesitant to go ahead and hire new workers. And we think about the headwinds that are at play in the U.S. economy. The first, for example, is the housing market. This is very much at the center of the recession. We've been reading increasingly dismal news about the housing market for several years now. And simply put, there are too many houses on the market that are unsold in the United States. And we can see that in the yellow area that looks at the inventory of unsold homes at the current rate of sales. That's more than doubled relative to a natural market. And we think of Economics 101, and you think of a huge supply of homes and limited demand, prices are going to fall. Prices have been falling in the U.S. for a couple of years now. And why that matters is that if you think about your own personal situation, odds are your house is one of the more important assets you own. And when its value is impaired, it's going to weigh on your confidence and on your ability to spend. This is one of these structural headwinds that are really keeping the U.S. market slowing, keeping it slow. And we can see a couple of examples of the U.S. government trying to accelerate this process, trying to speed up this economic recovery. We can see a couple of the highlighted areas, tax credits that were given to first-time homebuyers, really trying to take people who weren't in the housing market, try and give them a reason to go ahead and buy a home. And they would give you roughly $8,000 or $9,000 to do that. But the problem is that had you bought a house through that program, and then the program proved to be temporary and sales fell, which means that prices fell. So had you bought into that program, you would have received $8,000 or $9,000 as a tax refund, but your house would be worth $30,000 or $40,000 less. So that's not really a good program for stimulus. It doesn't really send the right kind of message. So again, a major headwind to the U.S. economy. If we flip the slide, we can see an even more depressing headwind to the U.S. economy. And I'm sorry for all the depressing news, but we'll get it out of the way soon, and we'll find something good to say later on. The U.S. labor market. Simply put, again, the labor market has lost a tremendous number of jobs. What I've done to just give you an example of how severe it is I've compared the job losses in the current recession, in the orange line at the bottom there, to previous recessions. And you can think back to the 1981 recession, which is in the blue line. At the time, it was viewed as a fairly significant recession, but fairly minor relative to where we stand today. You think about the 2001 recession, which is in the green line. The recovery from that recession was described as the jobless recovery. And it took a long time, almost 50 months, to get all the jobs back that we had lost. But look at where we stand today. It's just a whole other order of magnitude. And again, we can point to an example of governments trying to accelerate this process. You see that in the middle of the chart there, where the government hired a bunch of people to count other people as part of the census. Problem is, once you finish counting them, you didn't need those workers anymore, so you laid them off again. And we saw the rate of employment stagnate thereafter. And it's not, unfortunately, just that the U.S. has lost a lot of jobs, it's that people are unemployed for a longer period of time as well. If you look at the average duration of unemployment right now, it's close to 40 weeks. That's almost a year to go without a job. That has a pretty significant impact on your confidence. It also, your skills, unfortunately, over that period tend to atrophy. And the ability for you to get a job of a similar quality as one you lost is diminished. So this isn't just a cyclical story. This isn't just a story of a very long recession. I think this is almost more structural. That if you look over the next 10 years, the U.S. economy will not grow at the same rate it has over the previous 10. It's these type of headwinds that it's struggling against. So if you flip to the next slide. I want to find a little bit of optimism to talk about the U.S. It's tough, but I found one slide that I think could maybe give us just a glimmer, just a tiny bit of optimism. And what this slide shows is that it's from a survey of consumers, and they ask you, how do you feel about today versus how do you feel about the future? And if you feel better about the future relative to how you feel about today, this line tends to decline. And we see it coming out of the 90s recession, we see it coming out of the 2001 recession, and my nugget of optimism, just a tiny little nugget, is that we're maybe starting to see that today. So if you want to subscribe to the theory that is darkest before dawn, this is the kind of chart that you can look at. But again, I think we're very just in early days of this. I think those other headwinds that I've talked about will last a lot longer than what this chart will imply. So on the next chart, you can see just a couple of our numerical forecasts. Don't worry about trying to write all the numbers down. They'll probably change. But more importantly as well, we can make this PowerPoint available to anyone who's interested. But just to give you a sense of where GDP is expected to go over the next couple of years, very weak in 2011. In 2012, really not that much stronger. If you think of a trend rate of growth in the U.S. economy, which is basically the rate you need to keep up with population growth and the replacement of machinery, that's around 2.8%. So we're barely even getting back to that rate in 2012. So this means that the U.S. economy is going to unfortunately spend the next 2 years treading water. From an unemployment perspective, again, the labor market expects to be very weak, the unemployment rate above 9%. Even when it starts to improve towards the end of 2012, we're only getting to 8.9%, so unfortunately a very dark backdrop for the labor market. For the underlying rate of inflation, core inflation, still fairly weak by historical standards. Firms really don't have the ability to pass on price increases to their customers. The labor market doesn't have the ability to argue for higher wages, so inflation is not an issue for the time being. For the federal funds rate, for the monetary policy interest rate in the U.S., not the most exciting of forecasts, basically doing nothing all of this year, doing nothing all of next year. And only maybe until the second half of 2013 do we imagine that the policy will begin to increase. So the world of very low interest rates in the U.S. will remain very much in place. You can see that looking at 10-year yields as well. And just the point I would make as well is looking how quickly yields have fallen in the last couple of months. As I talked at the outset, a lot of the shocks that we've had really arrived very suddenly. They've all conspired in a pretty dramatic form to take a 10-year interest rate from above 3% down to something that should end the quarter around 2%. So a pretty sizable move there. So that was pretty depressing, right? Everyone wants to get up and leave, and maybe instead of lunch, you want to go to the bar. Let's just try and find a bit more optimism. Let's get that appetite back. So on the next chart, we're going to talk about Canada. And Canada's a remarkable story in this recession and in this recovery. And if you think about how Canada's unfolded, the Canadian economy never really had the same sort of structural headwinds as we saw in the U.S. The banking system remained functional. You heard that in the introduction, that Canadian banks continued to lend throughout the recession. The Canadian housing market as well did not face the same type of structural impediments. We didn't have a subprime sector. We didn't have teaser loans. We didn't have that style of exotic mortgage lending. So we've come out of it fairly well positioned. We didn't have any of the headwinds, but we got a lot of the similar amount of support. The Bank of Canada was quite aggressive in lowering interest rates. The government was quite aggressive in pushing stimulus into the economy. And when we look at how the different parts of Canada's economy have unfolded, we can see there's definitely leaders and laggards. The leaders include government spending. The leaders include consumer spending. Again, very much interest rate sensitive sectors of the Canadian economy. And this has helped economic growth recover in Canada. When we look at what's slowed economic activity, it's pretty clear. Exports in the orange line, that's been fairly weak. Again, not surprising given how weak the U.S. has been. As well as business investment, which again is a story about confidence. And confidence has been slow to come back. And I worry now that confidence will begin to erode once again. So when we look across these various drivers of growth, I think we continue to see weakness in exports, fairly clear given what's going on in the U.S. and in Europe. I think with confidence as well, starting to wane a bit, business investment starts to slow. But then you look at the lines that are above that axis, and there I think we're looking at a bit of fatigue. Consumers have done a lot of the heavy lifting, the housing market has done a lot of the heavy lifting. So to imagine how that helps from this point forward, I think I'm a little bit less confident. So I think we're ultimately left with a slightly slower trajectory for economic growth in Canada. On the next slide, you'll see one of the sources of support that I think does buy you a certain amount of time. There is an elastic that binds Canada and the U.S. together, but a chart like this shows that Canada is a little bit more resilient. And this chart shows the job growth that we've seen in Canada's economy. Remember the chart I showed you with the U.S. and how dramatic job losses have been relative to the start of the recession. This is a similar chart for Canada. Canada is probably one of the only economies amongst the developed market world that has actually reclaimed all the jobs that were lost during the recession. And it's done a pretty good job in adding additional jobs on top of that. So we can see we're well ahead of the game. So this, again, helps buy a bit of time. But remember that Canada, at the end of the day, as strong as we are domestically, we're still a small, open economy reliant on trade. And if we flip to the next chart, you'll see where the vulnerability in Canada's economy lies. This chart shows the correlation of Canadian real GDP growth with U.S. GDP growth. And typically, if something happens in the U.S., it will show up in Canada maybe a quarter or two later. So it's that adage that when the U.S. sneezes, Canada catches a cold. That still holds true in an economic context. Yeah, in terms of exports, we export 75% of our exports go to the United States. We are starting to diversify. We are sending more goods and services further abroad towards Asia and elsewhere. This is a very slow process. It's much easier to ship north-south than it is from the West Coast into the Far East. So what this means, unfortunately, is that with the two economies tethered together, the more weakness that we expect for the U.S., that will eventually show up in Canada. If you flip to the next slide, we can see just the numerical explanation of that. For real GDP growth in Canada, again, fairly subdued, still stronger than what we have for the U.S., which is a nice point to make, but nevertheless, ultimately, we can't quite escape the grip of the U.S. economy and some of the headwinds that we expect. In terms of the labor market, again, one of these very strong structural sources of support for Canada's economy that does certainly buy us more time to face these global headwinds. But I think a lot of the early job gains and the job gains we've seen so far were the easy gains to get. When we look at this point going forward, it's going to be a little bit harder to add to payrolls at this particular point. Firms are a little bit more hesitant to add additional employees than they were maybe 6 months ago or a year ago. So we forecast that the unemployment rate will tick up a little bit, but again, nothing too severe, and is expected to again reverse course heading into the second half of 2012. Inflation also is not expected to be a tremendous issue in Canada as well. Core inflation is expected to fade a little bit in tandem with a slower economic outlook, and again, gradually moving higher. For the Bank of Canada, in terms of interest rates, what it means for your mortgage rate, what it means for other consumer lending rates, probably again not the most exciting of forecasts to look at, 1% across the board. So the Bank of Canada will remain on hold through the end of this year, through the end of next year, and only by March of 2013 do we imagine that the bank will start to take interest rates higher. That will also be reflected in longer-term yields. And here, this is an interesting counterpoint to note that the bond market in Canada is very closely linked to the bond market in the United States. So with the Federal Reserve trying to add additional stimulus there, some of that bleeds north into Canada. So Canada gets the benefit of additional support from the U.S. to help, again, support the Canadian economy in light of these international headwinds. So let's flip the slide and talk a little bit about currencies. I'll make the observation at the start to say that at a moment of financial market crisis that we've unfortunately become quite acclimatized to, at the end of the day, what you seek as an investor is liquidity and a deep capital market. And when you look around the world, where do you see that? It's strange enough to note that we see that in the United States, even when the cause of the crisis is entirely due to the United States. We saw this in 2008 with the banking crisis. That was a U.S. phenomenon. The U.S. dollar took off. We see that maybe a little bit more legitimately when the first wave of the Eurozone crisis hit, where the U.S. dollar appreciated. And if there was ever an opportunity to sell the U.S. dollars and to get rid of U.S. dollar assets, it would have been during the sovereign downgrade. It would have been during the debt ceiling debate. But did we see it? Not really. The U.S. dollar managed to hold its own. And in the days after the U.S. was actually downgraded, the U.S. dollar went up. So when you think about this and you realize, well, if more can go wrong with the world than can go right with the world from where we stand today, you have to realize that the U.S. dollar will still maintain the interest of foreign investors. Which means that unfortunately this will have a pretty significant impact on the Canadian dollar and some of the other currencies we look at. So if we flip the slide, we'll start with Europe. Just a quick comment or two. We've noticed that probably the euro, despite all of the issues that it's had, has held in relatively well. Up until now, I think this was primarily driven by an interest rate spread, where interest rates were higher in Europe than they were in the US. That's begun to shift, so I don't see a lot more upside, I think, for the euro over the medium term. On the next slide, you can see some of the more of the structural issues. And this comes down to the amount of government debt that we see in Greece and elsewhere across the rest of the periphery of Europe. You can see the market's bet on a default in Greece is pretty high. It's just the market's expectation of that. I think, unfortunately, the market's onto something here. I think there's no way that Greece can actually get out from under its mess right now. It will have to default. The math that is necessary for them to either grow their way out of this problem or cut their way out of this problem is just too hard. It just won't work. So what are we seeing from policymakers who recognize this? They see that let's try our best to find a way to basically buy time for the banks that are exposed to Greek debt to eventually take that haircut. And the problem with this process is that takes patience. That takes patience on the part of private sector investors, which is starting to get frayed a little bit on the edges. It also takes patience on the part of governments, not just within Greece, but within the rest of Europe, who are asking themselves legitimately, why am I throwing more money into this when I know it won't actually end up? So at that particular point, I think we need to recognize that policymakers will have to do the right thing. We think they do get through it. There were some announcements this morning which were somewhat favorable to this end. It will be a very gradual process, but one, unfortunately, that is still very much about politics relative to economics. And if you don't trust economists, you should certainly not trust politicians. So unfortunately, that's the world that we're living in when it comes to Greece. On the next slide, we'll quickly look at the Swiss franc. The only point I'd make here is that when we look around the world at reserve currencies, people have viewed the Swiss franc as a reserve currency. But this has caused a great deal of problems within the Swiss economy. And instead, what policymakers have tried to do is to anchor the Swiss franc, to basically say, if you are trying to hold Swiss francs because you want a safe place to hide, we'll basically throw more Swiss francs into the market and depreciate that holding. So I think this action, there's two things that come to mind when we look at this. One is that you're fighting against the will of the market, and every time you see that, something goes wrong somewhere else. That's something I'm a bit concerned about. But as well, what you're doing is you're taking a list of safe haven currencies that are out there and eliminating one. You've gotten rid of the Swiss franc, you basically tied it to the euro. So when we look around the world and we try and figure out if people need a safe place to hide, where are they going to go? One potential is the Canadian dollar. You can imagine if the world wakes up tomorrow and decides that they want to park all of their assets in Canadian dollars, what that would do to our exchange rate. It would send it through the roof. And you know the damage that would cause to our economy, unfortunately, at this particular point in time. So we have to ask ourselves, is there a legitimate risk that the Canadian dollar can become a safe haven? And we go through some of the numbers and some of the analytics, and again, we can make this available for you later to look through the specifics, but our initial assessment is that we're not quite there yet. Canada is simply not large enough as an economy to be a legitimate safe haven. On the next chart, you can see that that view is reflected as well by the smart money, the hedge fund money out there. If you look at the green line, this is the speculative positions in the Canadian dollar. as basically there's no view currently being expressed one way or the other. If we start to see net long positions increase, indicating